Hey, before we jump in, just a quick reminder. This is all for educational purposes. Every investment comes with risk, so it's always a good idea to chat with a licensed financial professional before making any decisions with your own money. All right, today we're doing a deep dive on one of the most important and widely held investment funds on the planet, the Vanguard S&P 500 ETF, ticker symbol VOO. We're kicking things off with this quote because, honestly, it nails exactly what VOO is all about. This fund isn't trying to outsmart anyone or pick the next hot stock. Nope, its entire job is to be the market, to perfectly track the performance of the 500 biggest companies in the US. And that simple, powerful mission has made it a cornerstone of the modern financial world. And the scale here, it is just staggering. We're talking about a fund that manages over $850 billion. But, the most incredible number on this page is that expense ratio. Just 0.03%. That is Vanguard's secret sauce. An unbelievably low fee that means your money stays in your pocket, working for you. It's all possible because it simply holds the stocks needed to mirror the S&P 500, making it one of the most efficient ways to invest, ever. So here's our game plan for today. We're going to start with the core mission of VOO. Then we'll pop the hood and see how it works. After that, we'll check out its performance over the years, look at how real investors actually use it, and finally, we'll cover the risks and give you the final word.
All right, section 1, let's get right to the point. What's the big idea here? What is VOO actually trying to do for an investor like you?
At its core, VOO is what we call a passively managed fund. The best way to think about it is like a single shopping basket that holds a tiny piece of all 500 of the biggest companies in America. So when you buy just one share of VOO, you instantly become a part owner in all of them. You're buying a slice of about 80% of the entire US stock market. It's pretty much instant diversification made incredibly simple.
So how does Vanguard actually pull this off? How do they achieve that near-perfect mirroring of the market? Well, let's pop the hood and take a look at the mechanics.
The process is actually beautifully simple. It's just 3 steps. First, the S&P 500 index defines the universe of stocks, the 500 largest U.S. companies. Step 2, it weights them by market capitalization. Now, that's just a fancy way of saying the bigger the company's total value, the bigger its slice of the pie. And third, Vanguard just buys the stocks in those exact proportions. That's it. No guesswork, no fund managers making bets. It is just a perfect mirror.
And here's what that market cap weighting looks like in the real world. You see the absolute giants right at the top. NVIDIA, Apple, Microsoft. Because they're the biggest, they have the most influence on VOO's performance day to day. In fact, just these top 10 companies make up around 37% of the entire fund. As they go, so goes a huge chunk of the market.
Now, if we zoom out and look at the sectors, you can really see that modern tech dominance. Information technology makes up about 1/3 of the whole fund. But, and this is important, it's not just a tech fund. You still get broad diversification across all the other essential parts of the economy, like financials, healthcare, and consumer goods. That's what gives it balance. Okay, now for the million-dollar question, or maybe the billion-dollar question, how has this thing actually performed over time? Let's dig into the historical data.
The long-term numbers really do speak for themselves. Since it launched back in 2010, VOO has delivered an average annual return of around 14.4%. Now just let that sink in for a second. With the magic of compounding, a return like that has historically been enough to double your investment roughly every 5 years. That is the raw power of owning the market.
This chart really tells the whole story. You see that steady, long-term climb, but you also see the moments of pure drama. I mean, look at that terrifying drop in early 2020, followed by that unbelievable V-shaped recovery. And then there's the painful downturn in 2022. This image perfectly captures the deal you make with VOO. Incredible long-term growth potential, but you have to have the stomach to ride out some serious volatility along the way.
And that brings us right to risk. The one number you need to know is beta. VOO's beta is exactly 1. What does that mean? It means it moves in perfect lockstep with the overall market. If the market goes up 1%, VOO goes up 1%. If the market plunges 10%, well, VOO plunges 10% too. It's designed to give you all of the market's gains, but also all of its pain. So with all that in mind, how does this actually get used in the real world? Let's open up the investor's playbook and see the strategies people use to build wealth with VOO. Now, VOO isn't alone. Its biggest rivals are IVV from iShares and SPY from State Street.
For most of us who are investing for the long haul, VOO and IVV are pretty much interchangeable. They both have that rock-bottom 0.03% expense ratio. SPY, on the other hand, is the king for traders. It has gigantic trading volume and a huge options market, making it perfect for professionals making fast, tactical moves.
The range of people who rely on VOO is just massive. You've got everyday retail investors setting up automatic purchases every payday. You've got financial advisors using it as the core building block for their clients' retirement plans. And you even have huge institutions and hedge funds using it to deploy billions of dollars efficiently.
And they all tend to use a few common strategies. The most popular for individuals is probably dollar-cost averaging, just investing a set amount regularly no matter what the market is doing. And then, of course, there's the classic buy-and-hold strategy, which was famously recommended by Warren Buffett himself for most investors. Some savvy investors even use it for things like tax loss harvesting to optimize their returns.
How much VOO you own can also change throughout your life. This chart shows a typical glide path. Someone in their 20s, focused on growth, might have almost their entire portfolio in VOO. But as you get closer to retirement, you'd likely dial that back to preserve your capital. A pretty good rule of thumb you'll hear is 110 minus your age to figure out how much of your portfolio should be in stocks.
And here's another really popular way to build a portfolio, the core satellite approach. The idea is simple. VOO acts as the big, stable core of your investments. Then you can add smaller satellite funds to add different flavors. Maybe you add VXS to get some international exposure, or a bond fund like BND to add stability. All the while, VOO remains the solid anchor of your entire portfolio.
Okay, to wrap things up, we have to talk about the risks. No investment is a sure thing, so it's absolutely crucial to have a balanced view of VOO's potential downsides.
There are really three big ones to keep in mind. First is concentration risk. Because a handful of huge tech companies make up so much of the fund, if big tech has a bad year, it can drag the whole market down. Second, this is a US-only fund. You get zero direct exposure to what's happening in Europe or Asia. And third, and this is the big one, there is no downside protection. When the market crashes, VOO crashes right along with it. Its job is to hold, not to sell.
And that brings us right back to where we started. VOO isn't trying to be clever. It isn't trying to time the market. It is the market. It is one of the simplest, most powerful, and lowest cost ways to own a piece of the American economy and participate in its long-term growth. For millions of people, it's the foundational building block for a lifetime of creating wealth.
Thanks so much for watching. Remember, investing always involves risk, so be sure to do your own research, and maybe even talk with a financial advisor to figure out if an investment like VOO makes sense for your personal goals.